So the most important part of this course is the position sizing for the short put strategy. It's really important that you get the concept of managing your risk in any trade that you do, and it's no different for the short put strategy. So we're going to talk about the situation where you actually want to own the stock. So remember, we spoke about the short put strategy. You can use it in two ways. The first way is you want to position yourself in a stock, and then the second way is you just want a return based strategy. So let's talk about just owning the stock. So we would point you back to the asset allocation we talked about in the portfolio building course. So remember, we only allocate 5% to any one stock. For high dividend stocks, we're happy to allocate more, closer to 10%. But most stocks it's about 5%. So if you have a $10,000 account, that would mean you'd only be allocating $500 to any one stock. So let's take Cisco as an example here. Cisco was trading at about $25. So if you decided to sell a put option at the $20 strike and you decided to write one contract, what would happen in that scenario if you were assigned on the shares? And the answer is you'd be investing 100 times $20, because remember, in the options market, one contract controls 100 shares of stock. So you'd be investing $2,000. So this is over your allocation. So you need to be cognizant of that when you're positioning yourself and using the short put strategy and you want to own a stock. Now, if you wanted to position size based on a return based strategy, this is really, really important. Please remember that short put trades can go wrong. Sometimes the share price does drop below your short put strike. Now, if you've done this on a return based strategy, that means that you need to manage the position. So what we would suggest to you, if you are a total beginner or you're a risk averse investor or you're slightly nervous about risk, don't use the short put strategy. Instead, use the bull put spread, which is an extension of the short put strategy. But the benefit of the bull put spread is you've got defined risk. So your risk is a lot lower than using the short put strategy. The downside of it is you don't get as much money as you do with the short put. But we would advise total beginners to use the bull put spread instead. But even if you are an advanced options trader, always remember that trades can go wrong. So what do you do in that position? You need to have your trading plan mapped out. We talked about that earlier. So, couple of golden rules here with the short put strategy. Only apply it to fundamentally sound, rock solid companies. Really important to do that. And also only apply the strategy to companies with a high open interest on options. So in other words, there's a large volume of options traded. And the reason is the spreads on options are a lot wider when the volume is very low. So with high volume stocks, the bid-ask spread on options tends to be narrower, and that's really important. And always remember to keep your contract sizes small. So we'll give you some guidelines on the next page, and please remember these are only guidelines. Only guidelines. If your account is valued at 10k and below, don't use the short put strategy. Use the bull put spread. If your account is valued at $10,000 and over, you can apply the short put strategy if you're an advanced trader, but only apply it on a 1 to 2 contract basis per trade. Don't get sucked into thinking you're going to write 10 contracts of a short put and make a fortune out of it. You're much better off applying 1 contract trades to lots of different stocks than applying 10 contract trades to one stock. Consider the share price of the stock as well and the size of your account. So for example, a 10% move in Cisco against you is a loss of $250. Because the share price is only $25. But a 10% move in Google against you is a $70 loss per share or $7,000 loss per contract. So you're not going to be writing short puts on Google unless you have a sizable account. So the best thing to do is try to estimate a worst case scenario basis on the share price before you enter each trade. This will then form the basis of your expected risk, and we'll underline the word expected. So if, for example, with Cisco, you think the worst case scenario with Cisco is that the shares are going to trade at $22, well then your risk is, if you sold a $25 put, is $3 per share. So your maximum risk there would be $300. And the last piece of advice here in terms of position sizing is stay mechanical. There's absolutely no room here for sentiment with this strategy. Trade it as you see it. And again, a note for advanced traders, this is a really, really solid strategy for people who know what they're doing. But please keep your position sizing small. Really, really important lesson there.